if you focus on the wrong thing, that there's somehow valuation and amount you raise is somehow translates to success. It's just a bet on a short term to see what you can do with it.
Welcome, everyone. I'm Sejal Thacker, your host for this exclusive Nobody Studios live stream series. And for those of you that joined us last week, we started talking about this concept called a one-person unicorn. And so we're going to continue the conversation, but look at it from a different lens today. And so welcome back, Mark, to the show. So Mark, I wanted to continue our conversation. So last week we had our VP of our Idea Lab join us, Adam Bragg. And so for those of you that have missed our prior live streams, we have them all on our Nobody Crowd YouTube channel. You can take a look at that to kind of get caught up on what we're going to go up with today. But, you know, from the very beginning, Mark, one of the things that you've said is, look, Nobody Studios is not chasing the unicorn. That's not part of, not something that we were striving for. And instead, we adopt a frugressive approach. So can you share your reasoning about why you've chosen this, I don't know if you want to say mindset or strategy for the studio?
Yeah. A lot of the thesis that went into the original studio business plan came from my entire career of, doing 12 different venture-backed startups and seeing the ones that went well, seeing the ones that didn't go well, and even the ones that went well could have gone way better. And a lot of the ones that didn't work were this close to success. And, it's kind of counterintuitive to a lot of people, but a lot of times capital at the wrong time or too much capital or the wrong capital had a huge impact on the trajectory of the companies that I've been a part of. And it translates into things like board dynamics and how you make choices. But what a lot of people don't understand, and I don't think it's very commonly talked about it, like founder level tutorials or training camps or whatever, is that fundamentally your cap table. So the ownership structure of your company, who owns what, how much you raised, has such a dominating effect of the outcome of your ultimate company. And people don't realize that if you raise too much money, one of the things we've said all along is that if you look at the stats of people who exit companies, so build a company and sell them, 80% of exits happen under $300 million. So that sounds like a lot of money, and it is a lot of money. But when you juxtapose that to what was going on in the market, especially 4 years ago when we wrote this thesis, everybody was on this unicorn party, unicorn or bust. I remember when there was only 4 or 5 unicorns. Now there's like 1,400. And something we were saying back then was, this is not going to end well, guys. Like, this isn't a new generation, new math. Like, this doesn't end well. And it's because of what I've seen the last 27 years of my career. When you overcapitalize, especially before a company has truly proven their product or their market fit, and they haven't even validated that there is a multiple $1 billion a year revenue opportunity in their business model, raising that kind of money puts you on a path where there's like only a binary option. You somehow find rocket ship trajectory and you create, the $10 billion outcome, or you fail. And when you fail, you've probably hired hundreds of people because you have this new capital. You're going to have to cut back dramatically. You probably have hundreds of investors who've gotten involved at a valuation that you can't sustain, meaning you have to raise money to lower valuation, and that starts to hurt or wipe out previous investors. So the employees and the investors who help create this thing are the ones that are hurt the most. And so I've just seen it time and time again. We were very, very unpopular when we were saying that unicorn party was going to end up bad. We didn't believe in it. We fundamentally, just to give you a clear juxtaposition, we believe in building great companies, really frugally, very aggressively, low budgets. We're glad to build a company for $1 million and sell it for 50 all day long, twice on Sundays. And that's what the studio is built on, is early to mid-stage exits. And we also believe that with the speed of technology and how fast things are changing, trying to build something over 10 or 15 or 20 years where you can actually get to a 10 or $20 billion exit, we think it's 10 times harder to do today than it was 5 years ago, and even harder in 5 years from now. So again, it lends itself to make something meaningful, get product market fit, raise the capital you need, but not too much, And when an exit opportunity comes along, take it and go back and do another one. And that's how we think.
Yeah, no, that's what I was going to go. You read my mind. And I want to just put up that article that you were just talking about here. It's obviously that we could have a whole episode about, even though this was part of our thesis 4 years ago, about how challenging, even more challenging it is now to get to that unicorn status. I didn't even know what this term was when you mentioned it to me, the unicorpse, right? Until I started learning more about it. But yeah, it's even harder to stay at that status now. And talk to us a little bit about why that is.
Well, again, and don't get me wrong, like if you can build a great company with product market fit and focus, and you can get to tens of millions and hundreds of millions of dollars of revenue, then you're going to be $1 billion valuation company. And that would be a unicorn all day long. Please. We strive to build the same kind of companies, but unicorns started to become more about valuation at an early stage startup. And, I met dozens of founders in the years I was writing the thesis for the studio, and they all would say their goal is to become a unicorn. And the thing that broke the back for me, and I finally burnt the bridges and called all my friends and I said, okay, I know I've been talking to you about it for a year, but I'm going to do the studio, was I met a founder who told me his goal was to be a decacorn in his space. And I actually had to think about what the hell that meant, but he thought he was going to be worth like $10 billion. Again, great goal if it's on the back of building great products that people want to pay for and you have revenue to show for it. But the idea that you're chasing just a valuation as actually the victory showed me how little people understood, especially founders and unfortunately a lot of investors, how little they understood about how raising too much money affected the dynamics and the cap tables and the outcomes for everybody, and put you into this 0.1% outcome, or like you had to be like the MVP of the Super Bowl kind of outcomes. And most of the people I know who've done very, very well for themselves in startups, they didn't create Microsoft. They weren't the names you'd know about, but they created really great companies and had great exits. And that's where I think most founders should be focusing on. And if you were lucky enough to get on something where the trajectory is super big, it'll be obvious to you. But when you're defining it and calling it, it has to go big or else at an early stage, I know it doesn't end well for folks. So that article, as you said, the unicorn concept, I think Fortune coined the term. But we started talking about Fortune, unicorns. I think that article came out in 2016, the pretty unicorn there. And there was, again, there was 4 or 5 in the market. And I think that year we had like 20 companies that had raised at $1 billion valuation. So it was like, hey, there's actually a bunch of people now reaching this status of $1 billion valuation. And now there's 1,400, right? It became a thing. But it was almost like we all got into this fever, both investors and founders were demanding it. We got all this fever of creating this concept of a unicorn, but the unicorn is just a paper construct. How much money you put in at a certain valuation, it has no value and it doesn't support itself. So it's only a temporary. And it's this idea that hopefully that capital can translate into building something meaningful. But if all you needed was to give people capital to succeed, we'd have a lot more successes out there. So I do think we got into this. I think the whole market got a little intoxicated with this concept. And again, one of our slides has a picture of a unicorn, and it says everybody's betting on unicorns. And this is in our pitch deck 4 years ago. And in parentheses, it says good luck with that. This is not going to end well for most people. And now this article came out last month, again, the same cover, the age of the unicorpses. And it kind of says what I'm saying, which is, there's probably 1,000 of these unicorns are not going to succeed. They're all looking for capital right now. Most of them are expecting a down round, meaning it's going to hurt investors. Most of them are cutting staff. Don't get me wrong, there are unicorn paths. You're going to build a Groupon or you're going to build an Uber. You probably have to raise a ton of money and go really big, really fast. But 99.9% of startup ideas don't need to think that way.
Yeah. So for people that are joining in, this conversation is resonating. I'm seeing some great comments coming into the chat. Here, let me just put this cover back up. So this idea of the unicorpse, right? That's a term that's really sort of playing on the term unicorn, which, as a startup that's gotten that valuation at over $1 billion, that makes the unicorn, but then has since failed or drastically declined in value. And so it becomes essentially a corpse, right? So in terms of its financial status, so it's a play on the word unicorn and corpse. And so, Mark, there's plenty of examples, right, of companies that have achieved the unicorn status and then since failed. Maybe you could share a couple of examples of companies and Give us some of your perspectives on why they failed or lost value so quickly.
Yeah, look, I probably prefer not to single out any individual company because there's always so many backstories and there's always a whole bunch of reasons, right, behind why companies do or do not succeed. There's leadership issues, there's toxicity within the organization, there's board conflicts, there's a lot of times there's just, misdirection on the product. There's things that disrupt you externally. So, I always hate opining about something that I don't know deeply about a particular company because I just feel like if I'm them, I'm going to be very mad. And if I know a lot about a particular company, then I'm probably too close to them and feel too confidential to share what I do know. But I can speak to my own journey. I have done 14 startups prior to the studio, most of them venture backed. And even the ones that had great outcomes, far and away could have been even way bigger, right? And so I do believe that if you do get a chance to be on a stage in terms of a certain valuation and access to capital, if you mess it up, which is more likely if you haven't gotten real product market fit, that sucks. But if you do the right things with those moments, the sky is the limit. You can springboard to any level you ever want to within your kind of dreams or focus within the startup community. I think that a lot of people, when you raise too much money, you focus on things that don't matter as much to really creating a viable long-term company. And I love to have cool environments and culture, as and I recruited you and I was still in the garage and you can hear my dog barking because I think culture is fun. But what I'll say this statement, like people raise a bunch of money and they start worrying about what the color of their pool table is going to be and their foosball table and the color of their lobby. And those are fun things to think about. But at an early stage, you need to be focused on what is the problem my customer have? How do I solve that problem? How do I delight them? How do I make them paying me my service or my fee the easiest thing they do because of the value that I bring them? And I just believe that doing that right requires a maniacal focus. And if you are focused on these other things, and it's almost like pre-celebrating success, and you've heard me say it, we've got acknowledged along the way as a studio of doing a couple things right, hopefully, or being acknowledged. I'm like, great, celebrate it for a minute. Now let's go back and work and earn that acknowledgement because we're still super early in this journey and there's millions of more customers to delight before we know we're on the right path. And so again, keeping the focus on the right thing and not getting distracted by false victories. And that's kind of what I'd say. I think raising a lot of capital at a big valuation is a false victory.
When I was preparing, I was like, let me look up some examples, right? And the one that I recognized and that jumped out at me that I had actually heard about was the one with Elizabeth Holmes, right, with Theranos. And when one of the articles I was reading said, this is a perfect example of a unicorpse, right? They were valued at over 9 billion, and then it went downhill after there were some claims that the technology wasn't doing what it said it was or how it was advertised, and then the company ultimately shut down in 2018 when Holmes was facing all kinds of criminal charges, right, related to misleading investors and patents. And so that's one example, but there's plenty of examples of companies that were initially valued, the overly optimistic, I would say, initial valuation, and then it went downhill, right? So our progressive approach has always resonated with me, Mark. I think I've seen this happen with several of our new codes now, where we place a strong emphasis on generating the profits from the outset, right? So how are you paying for what you want to do and how you want to build, right? So our founders are focused on building those business models that deliver value while they're generating the cash flow and returns for investors. So can you share an example of one of our new codes and how this sort of plays out at the studio?
Our focus is, everybody's heard about MVP and minimum viable product. Like we sometimes talk about minimum viable company in terms of like, how can you get laser focused on a problem, which gives you laser focus on a message and a laser focus on a go-to-market, which again, our model is to make smaller bets, but get, a lot of return from those things. Again, if you are really focused and it's a big enough market, it's the antithesis of being too broad in your roadmap, right? When you're too broad in your roadmap, you're trying to be a lot of things to a lot of customers. You're probably creating a roadmap that's going to take you years to achieve. So you're going to probably under deliver on your message because you're overselling your vision versus your reality. And when you get disciplined and saying, this is what I can do now, and it has high value, and I'm going to be focused on that, you put yourself in a situation to over deliver and delight your customers. So Evalify is a good example of that. We're passionate about the IP space, intellectual property, and how you look at IP as being an inspiration for the companies you create, but also a really important data point for the companies you create or the companies you invest in. But if you look at our original roadmap and thinking about what we could do with IP, it was this big, long, massive behemoth of opportunities and ideas, very enterprise-ish in terms of platform, and certainly multiple years of development to deliver on that. And we narrowed on one particular piece that we liked, which was understanding the IP risk of a concept. If you're investing in it or building it, is hard to ascertain. You can hire attorneys. We all know attorneys charge a decent amount of money per hour. It could take weeks, potentially, or months to get a report back. There's not even a standard for what it would look like if you asked an attorney to say, size up this IP risk for me. So you might get one thing for 10,000 and something else for 80,000, and a lot of things mixed in the middle. So we love the idea of, could we standardize everything you'd want to know in terms of IP risk with a click of a button? And it's kind of like the Carfax, you buy a Carfax for a used car. This idea of like Carfax for an investment around IP. And what can I say? We did it. 6 months into it, we've got AI built around this. You can upload a pitch deck. We'll extract the features out of it and understand what you're trying to build. We'll weigh that against 180 million patents in over 170 jurisdictions worldwide. We'll come back with a score, giving you a relative risk that we see in terms of the IP risk of that particular investment, and a full report on conflicts you're going to have within that IP space, people who own the biggest patents in that category, things you might do differently in your IP to get better protection, and adjacent possibilities, things that you're currently thinking of that could have potential in other areas if you expanded your IP filing. It's probably tens of thousands of dollars of legal work with a click of a button in 1 minute for $249. And we just started socializing it to the market in a very social, subdued way, just to our internal networks. It's already in revenue. A lot of great conversations with folks that want to take it big, and we're having fun with it.
Yeah, and thank you, Anthony Hall. Grandpa Stork is joining us, and I appreciate you signing on. And he made this important message. He's obviously, we're putting a lot of messaging out about Evalify right now, and he said the messaging that he's been receiving has been mainly targeted at investors. So can you talk a little bit about that? And is it only for investors? Is it for founders? Who's the main target market for that? And what can people do if they want to learn more about Evalify right now?
Well, yeah, like all of our companies, first of all, we're an open book. So if you guys have ideas or you want to talk to anybody at the studio or at Evalify, you can just reach out to anybody at the studio. I'm Mark at Nobody Studios, Sajal at Nobody Studios. William Carbone's the CEO of Evalify. We're all responsive, so you can reach out anytime. The website's live at evalify.ai, so you can upload a pitch deck and get started. And yeah, I guess to Grandpa Stork's comment, we do believe it's relevant for founders. But if you think about a business kind of model canvas, at the end of the day, founders build companies every 3 to 5 years. They tend to believe they have it all figured out. Guilty. They have no money. Guilty. So as a target segment, it kind of makes sense that they would want to use this, but it's actually not the best possible fit. Whereas VCs, investors, family wealth, family offices, even insurance companies, and now we're finding IP attorneys have a lot of volume where they're looking at a lot of deals, and this has a lot of value, and they have the resources and capital. So we're really focusing on those segments that are massive, established, again, have budget, have pain points, and have volume as our initial starting point.
Thank you for that. Thank you. Yeah. And then he wrote, it's a great tool for entrepreneurs and inventors. I mean, I'll just say from the legal perspective, this is a game changer. I've said that in a lot of my responses to people as we're starting to post about this on LinkedIn. I mean, this is such an important area to disrupt, because if anybody has ever tried to figure out IP issues, or in every state, every jurisdiction has, like, there's federal, issues that apply. And so you have to navigate through different platforms. And if anybody's ever tried to look up anything on any of these websites, you'll see it's like it's like trying to find a needle in a haystack. They're not very easy. They're not customer service oriented. It can take hours. And like Mark said, you usually have to go to an attorney at the end of the day anyway to confirm that the stuff that you're finding online is up to date and relevant. There's thousands and thousands of patents being filed and asked for, and some of them, because of the pandemic, it has slowed down the processing of a lot of this stuff too. So there may be things that are pending that they're not even on the websites that you're looking at. So this is really going to speed up the process for a lot of people and helping them make better decisions, right? And so, but I think Evalify is a great example of something that we've already been, it's open right now. People can go in onto the platform and test it and give us your feedback on what we can do to continue to improve this. But we're getting a lot of great positive feedback and look forward to everybody who wants to support us. So again, go to the Nobody Studios website. Evalify has its own website, and you can link on there to try this platform out and see, if it works for what you're trying to deal with. So Mark, I wanted to, one of the things that came up to me as I was sort of preparing for this was when you think about like progressive startups and the model that we're sort of, adhering to when we build our companies at the studio, a lot of times, there's this like risk that you're afraid you're going to be overlooked or dismissed because there are certain investors or industry stakeholders that, they look at success and they equate it with that unicorn status. We were sort of battling this a few years ago. So there are some people that are just going to overlook and say, but for founders, for entrepreneurs that are trying to break through that noise and gain visibility in a market that's, saturated with unicorn hopefuls, this could be really challenging. So some of the things I know we've done at our studio is build credibility. We've got a strong brand identity. We're really good at communicating our value proposition to overcome some of these challenges. But what advice do you have for founders who are trying to incorporate sort of like what we're doing, a progressive model, and trying to break through that noise?
Really, to the heart of what I would tell founders is like your valuation is nothing and what you raise is nothing. And so there are plenty of examples of people who've raised great amount of money at a nice valuation that nobody knows of and they disappeared. And it was really painful for the founders and painful for the investors. So that probably happens 90% of the time. So again, just this moment of time saying you got a valuation or amount raised, certainly it's an important goal. You need a certain amount of money to build the things you're trying to build. But if you focus on the wrong thing, that there's somehow valuation and amount you raise is somehow translates to success. It's not. It's just a bet on a short term to see what you can do with it. And too much money tends to bring a lot of complications, a lot of politics. It probably turns most founders into employees, which takes away quite a bit of what founders got into this for to begin with. And so I always say, like, there's a time and a place to go bigger. Go big when you've proven things out. And I truly believe that suffering and maxing out your credit cards and stretching, yourself and your team, like, not everybody survives that. But you end up getting the best teams and you focus on the things that matter, which means you build great products with customers that love you. And that's what you should be the business for. And most of the people, there are examples on the extreme, but most of the people who have really built great unicorn type businesses that I would point to and say, man, you should be proud of that. I have no problem with you being a unicorn. They've been around 10 or 14 years. It's that 14-year overnight success. They have just continued to execute against delivering on customer expectations and exceeding their expectations and building revenue. And they earned a big valuation and they're able to raise big capital, but they're able to do it at the appropriate time. And that's what I would tell people, because there's so many early stage startups chasing the dream of valuation and money raised. And I think more often than not, it hurts early stage startups.
That's excellent advice for all the founders that are listening to us today. And so I have two more questions for you. We're already at time, but two quick ones. One, it's been 20 episodes. So what is one of the great, like in your mind, I know we've accomplished a lot since we started doing this together, but what is one of the biggest milestones that we've achieved at the studio since we started this live stream?
Look, I think that for us doing the crowdfunding last year was probably the biggest milestone. It was a culmination of a lot of work for 3 years and vision and people and hard work. But the minute you had to deliver on a dream that we always had, that we'd make this available for the masses, the ability to be a part of early stage, venture creation and all the returns that it exposes you to be really honest, it would have been an easy thing for us to walk away from and say, oh, I know we said we're going to do it, but we didn't do it. We had capital coming from other sources. The crowdfunding wasn't going to be an efficient, really capital source for us. But we did it because we believed it was important to deliver on our core DNA, which is always to have the crowd involved and to make this available to everybody. And it also forced us, it was a forcing function to do a lot of things we knew would make ourselves a better company. So we had to articulate that message. We had to be ready to be public about it. We had to figure out how to talk about our story like radically in 20 different categories. All of our team had to come out of the woodwork and put themselves, on the surface and be interviewed and do live streams. And like, I think we all are better for that. We also had to do 2 years of audited financials. We had to be approved by the SEC. There are a lot of things that made us a way more mature early stage startup than we would have been otherwise. And I knew that going into it. So a lot of these things, when I decided to do the crowdfunding, I really expected it would be kind of cash neutral. When you look at all the effort and time and everything else and money we put into it, it probably was cash neutral. So it wasn't a fundraising exercise for us. But the team is infinitely stronger. Our message is infinitely clearer. We built some muscles in terms of how to communicate transparently. And I think a byproduct of it is we have 1,000 investors in 56 countries, and they're now part of our superpower. They're bringing their ideas, their passion, their network, their connections. That was something that we said 4 years ago. We brought it to reality. And I think it's important to bring things to reality that you say you're going to do. And the byproduct of that at the end of the day is I think we have one of the biggest brands in the venture studio space because of the crowdfunding goal. So I think that was probably one of the biggest milestones we've accomplished, and we're knocking on another one.
Yeah, so that's where I'm going, and that was super exciting. I'll tell you what, that was the first time I've gone through anything like that, and man, that momentum we built, and that continues to this day. I still get people are always reaching out to me, and I'm talking to some of our equity crowdfunders as we try to figure out ways to engage them and see how they want to contribute to this journey and these conversations. And so I had Connie on here on the Nobody Studios Culture live stream. And she put me on the spot, and I'm going to do the same thing to you, Mark. She asked me, she goes, you have to get really good at storytelling, right? When you're doing like an equity crowdfunding campaign, in 30 seconds or less, you got to tell, why should I join the journey? So she asked me to in 30 seconds, and I went way over 30 seconds, but you've got 30 seconds to tell people why they should be joining our journey now. So let's see if you can keep it in 30 seconds or less.
Here's my answer. So I was on a podcast not too long ago, and we ended the podcast just like you are now. And the question was, how will you know you arrived?
Mm-hmm.
The host said, you got an intoxicating vision. Nobody's so exciting, but how will you know you arrived? And I said, I believe that in the not too distant future, an entrepreneur I have not met in person from a country that I've not been to physically, and I've been to a lot, is going to bring an idea, solve a problem that I don't resonate with, and they're going to propose a solution that I'm probably even dubious about, and they're going to bring it to life in the form of a company that makes the world a better place and is a viable, profitable business using Nobody Studios. That'll be the day we arrived. And I would just say, if that resonates with anybody listening, that's why we're called Nobody. It's bigger than any one of us. And for me, it's why it's worthy of getting out of bed for. And if it resonates with you, you should figure out a way to be part of the journey.
I know we have some exciting announcements that we're going to be making soon, but is there any way you can share just one of them with us now for everybody that's joining?
Well, yeah, look, when it comes to financial matters, one, I'm pretty conservative about how we talk about things, and I usually don't pre-celebrate, but we've had some really great conversations with folks that we're really enjoying, and we certainly expect that probably going into the summer, we'll be announcing a pretty big announcement in terms of our financial support and what that means to our growth and our reach. And I think that everybody who's currently a Nobody, and folks that want to join us in the future, it's just going to keep making our vision come to life. And proud of the team and everything we've done to some of the bold choices we've made to get into the spot. Keep your eye on the ball until it's across the goal line, and that's how we think about everything. But yeah, I'm very encouraged by the direction things are going.
Awesome. Thank you, Mark. This was a great episode. And thank you everyone for joining. I love the comments, and Anthony Hall gave a great idea, Mark, for us to keep in mind about possibly doing a workshop on Reg CF, right? And this is an area that, again, maybe a lot of people don't know about. Maybe we can put some content out there or think about doing something like that. So everybody, thank you again for joining us. Thank you again, Mark, for sharing your wisdom, and I'll see you next time.